let's get more from Alan Heap this morning. He's the Managing Director of Global Commodities at Citigroup Global Markets, and he joins us from our Sydney bureau. Alan, what do you think of this talk of a possible watered-down super profit tax here? Do you think that might actually be employed?
I think it's likely, but it's really the impact on the commodity markets that's more my field.
Okay, well, let me just ask you then, what about the impact on the commodity markets? And some are saying that in the end, if this tax is levied in its current form, it's going to basically shoot up prices of commodities in the future because you have to pass it on to the end users.
Well, to an extent, I think that's possible. The main markets that are most likely to be affected are iron ore and coking coal, where Australia is such a dominant source of supply, and if projects get delayed because of this, that's going to be an important factor supporting prices.
Okay, when projects get delayed, that means the supply is also, I guess, stuck in the pipeline. That means prices go higher.
Correct, especially for those commodities where there is a real chronic shortage of supply, most particularly iron ore, and also iron ore over the next 3 years or so, and for coking coal for an even more extended period than that.
Yeah, and for a more extended period than that. Let me just talk to you, Alan, about iron ore and coal, because earlier this year I was speaking to a lot of commodities analysts and commodities, I guess people who invest in commodities, and they're saying that iron ore and coal, the bulk commodities, are really the best plays so far in 2010. Has that really been the case?
Yes, it has. The pullback that we've seen in the base metal markets has been far more severe than we've seen in the bulk commodity prices. The supply-demand fundamentals are much more robust.
Yeah, so going forward, Alan, are these still the two best bets in the commodity space in your view?
Depends how far forward you want to look. Once you get beyond sort of 2013, the iron ore market starts to move into oversupply by our work. Because of by that time there will be a lot of new supply coming from the Australians and also from Brazil. But coking coal looks tight as far as the eye can see.
Okay, and what about gold prices right now? Let me quickly touch on that with you, Alan, because a lot of people are focusing on gold as a safe haven from the volatility that we're seeing on the stock markets at $1,212 an ounce. Do you think we're going to see it go much higher from here?
It all depends on how bad you think things are going to get in Europe. Gold is at the moment fulfilling its traditional role as a safe haven. It's rallying despite US dollar strength, and it's rallying because investors are once again concerned about sovereign risk. So if you think the situation in Europe is going to get a lot worse, gold's going to go higher.
Yeah, and what do you think about the sovereign risk in Europe? Is it going to get a lot worse, or are we pretty much on hold here?
I have no idea. I'm not an economist. I'm not a central banker.
Okay, so Alan, how about do me a favor here? Let's take a look at gold prices. Let's say in the next few months or so. I mean, what's the peak for gold in 2010?
Certainly 1,500 is possible. Some are talking 2,000. I wouldn't necessarily subscribe to that view.
Okay, so 1,500 possible, but what's likely in 2010 then, Alan?
Our formal forecast is for 1,250.
Okay, we're pretty close to those levels. Okay, Alan, nice talking to you today. Thanks for your time. That's Alan Heap, who's the Managing Director of Global Commodity Analysis at Citigroup. Now.